$2.5 trillion. That is a loaded gun pressed directly against the temple of the global economy. And as of April 21st, according to the strategic calculus of the Iranian Revolutionary Guard Corps, that trigger is going to be pulled. The mainstream media is calling it a risk. I'm calling it a certainty. The only question is, are you protected? I've spent the last 12 years tracking liquidity cycles and geopolitical risk for institutional funds. I cut my teeth in 2008, watching complacency wipe out 40% of people's net worth overnight. And in 2020, when oil futures literally went negative, I was one of the few telling my community to buy the physical dip while everyone else panicked. I'm telling you this not to brag, but to establish credibility. Because what is about to happen in the Strait of Hormuz is not a media narrative. It is a structural break in the global energy market. And if you don't understand the mechanics, you will be the one holding the bag when the music stops. For years, the financial establishment has told us that energy shocks are a thing of the past. They said that American shale made us immune. They said that strategic petroleum reserves were a sufficient cushion. They said that the Strait of Hormuz, the world's most critical oil choke point, was too important to actually close. They were wrong. They are always wrong. Right now, we are watching a perfect storm of geopolitical miscalculation and economic vulnerability move from impossible to inevitable. The narrative you're seeing on CNBC is that this is just saber rattling, that Iran is bluffing. But they are missing the hidden mechanism. They are missing the math. I'm going to break down three critical things that no one else is connecting. First, I'm going to show you the exact historical precedent, the specific dates and numbers that prove a blockade isn't just possible, it's probable. Second, I'm going to reveal the hidden liquidity trap that turns an oil price spike into a cascade of margin calls and forced selling in your 401k. And third, I'm going to give you the specific actionable positioning framework, the exact tickers and allocation percentages that I am using right now to not just survive this shock, but to profit from it. But before I get to the strategy, I need you to understand one thing. This isn't about politics. This is about physics. And the physics of the global oil supply are about to break. To understand why April 21st is the date, we have to look at the pattern. This is not a new playbook. This is a 50-year cycle of energy leverage. First precedent, 1973, the Arab oil embargo. In October of that year, OPEC proclaimed an oil embargo against nations supporting Israel. In 3 months, the price of oil went from $3 per barrel to nearly $12. That's a 300% increase. The result? The Dow dropped 45% over the next 2 years. The mechanism wasn't just expensive gas. It was the transfer of wealth and the subsequent stagflation that broke the post-war economy. Second precedent, 1979. The Iranian Revolution. In November of 1979, the Iranian oil sector ground to a halt. Global supply dropped by roughly 4%. That 4% shortage caused panic buying that sent prices from $15 to $39 per barrel, a 160% surge. It triggered the second great oil shock. Lines at gas stations. Rationing. The mechanism here was fear. Third precedent, 2022. The Russian sanctions. When Russian oil was taken off the market due to the Ukraine war, Brent crude spiked to $130. The market reacted violently, not just because of the oil itself, but because of the margin calls in the commodities futures market. We saw the LME nickel fiasco. We saw major brokers nearly collapse. The mechanism was leverage. Now here's the pattern. Every major oil shock happens when a geopolitical event intersects with a fragile financial system. In 1973, it was the end of Bretton Woods. In 1979, it was the Volcker inflation. In 2022, it was a zero interest rate bubble. And today? Today we are sitting on the most levered, most fragile financial system in human history. The trap door is open. April 21st is the wait. Here's what most people miss. The mainstream press is pinning this on Iranian aggression. They are framing it as a random act of a rogue state. But the real trigger is a technical, mechanical inevitability based on U.S. policy deadlines and Iranian retaliation timelines. Let me show you the three critical factors that are converging on April 21st. On October 18, 2025, the United Nations sanctions on Iran's missile program expired. Since then, Iran has been ramping up rhetoric. But the real kicker is the snapback provision of the JCPOA-Iran nuclear deal. If the European signatories, UK, France, Germany, trigger the snapback at the next IAEA Board of Governors meeting in late March, all UN sanctions on Iran snap back into place by mid-April. This includes a full embargo on Iranian oil exports. Iran has explicitly stated that if they cannot export oil, no one in the Gulf will export oil. Here is where the date becomes specific. It takes roughly 21 days for a very large crude carrier, slooks, to transit from the Persian Gulf, around the Horn of Africa, to the Red Sea or the Western markets. If the snapback is triggered on March 31st, by April 21st, the first wave of Iranian oil will be legally blocked. Iran's military doctrine is based on active deterrence. They will not wait for a diplomatic solution. They will act the moment the first tanker is seized or the first ship is denied passage. They have 4,000 mines. They have anti-ship ballistic missiles. They have swarms of fast attack boats. The Strait of Hormuz is 21 miles wide at its narrowest point. Shipping lanes are only 2 miles wide in each direction. You don't sink a tanker to block the strait. You just sink one. The insurance rates skyrocket, and the captains refuse to sail. The strait closes itself. And this is where the financial system gets hit. We are currently in a period of backwardation in oil futures, meaning spot prices are higher than future prices. This incentivizes drawing down inventory. But when a supply shock hits, the curve inverts violently into contango. Traders get squeezed. The commercial hedgers, airwires, shipping companies have to cover their shorts at massive losses. This is not a slow burn. This is an explosion. So let's walk through the mechanics. What actually happens on April 22nd? When Iran mines the Strait or fires on a U.S. warship, the price of Brent crude doesn't just go up $5. It gaps. It jumps $20, $30, maybe $40 in a single session. We could see $150 oil overnight. Here is the cause and effect chain. When crude spikes to $150, it triggers massive margin calls across the energy futures complex. Those margin calls force leveraged hedge funds and commodity trading advisors to liquidate profitable positions to cover losses. They don't sell their oil futures. They sell their winners, the tech stocks, the high-flying AI names, the Bitcoin. This forced selling cascades into the equity markets. Simultaneously, the higher oil price acts as a tax on the consumer. Every $10 increase in oil takes roughly 0.3 to 0.5% out of GDP growth. At $150, you're looking at a 2 to 3% drag on an economy that is already slowing. I'll show you exactly how to position against this in a moment. But first you need to understand why this isn't just about gas prices. This is about a liquidity vacuum. The Federal Reserve cannot cut rates into an oil shock because it would exacerbate inflation. They are trapped. We have a policy error happening in real time. This is not just an energy crisis. This is a systemic flush. This flows to the airline sector first. Airlines operate on razor-thin margins. Fuel is their biggest cost. When oil spikes, their profitability evaporates. We will see bankruptcies. We will see the government forced to choose between bailouts and letting them fail. Look at the JETS ETF. It will be the canary in the coal mine. Then it flows to the consumer discretionary sector. Think about the American family. They are already maxed out on credit card debt. They are already struggling with rent. Add another $200 a month at the pump, and that money has to come from somewhere. It comes from Amazon orders. It comes from eating out. It comes from concert tickets. Companies like Starbucks, Target, and Home Depot will see a brutal flush in same-store sales. And ultimately, it flows to the banking sector. Those margin calls I mentioned, if the leverage players can't meet them, the prime brokers take the loss. We saw a mini version of this in the UK gilt crisis of 2022, where pension funds nearly collapsed due to a spike in yields. This time, It's oil. It's bigger. It's global. The trap door isn't just open. The floor has been removed. So if I were starting from scratch today, with this April 21st deadline looming, here is exactly how I would position. This is not financial advice. It is my personal framework. I am moving into a barbell strategy. Safety on one side, speculation on the other. About 60% of my risk-off capital is going into direct energy exposure. Not the broad market, but the specific assets that benefit from a supply shock. First, the United States Oil Fund, but be careful, this tracks futures, so there is roll yield risk. A better option is ProShares Ultra Bloomberg Crude Oil if you want leveraged upside, but that is for traders, not investors. Second, the oil supermajors with strong balance sheets and refining capacity, specifically ExxonMobil and Chevron VX. They have the cash flow to weather volatility and return capital to shareholders. They also own refining assets, which benefit from the crack spread, the difference between crude input and refined output, which explodes in a supply shock. About 20% is going into shipping and infrastructure. If oil flows are disrupted, the available tanker fleet has to travel further, increasing day rates. Look at the Energy Select Sector SPDR Fund flow for broad exposure, or a specific tanker play like Frontline PLC FRO. The remaining 20% is for the contrarian play, gold. If this triggers a recession, and the Fed has to choose between inflation and a banking collapse, they will choose inflation. They will print. Gold is the hedge against that policy error. Now, let's talk about what not to do. Because in a crisis, the mistakes will wipe you out faster than the market. Everyone thinks FANG is a safe haven. It is not. Tech is a long-duration asset. Its value is based on earnings years in the future. When a liquidity crisis hits, investors sell the assets with the longest duration first. Tech will be the primary source of liquidity to cover margin calls. Buying the NASDAQ dip in April is not bravery. That's volunteering to be exit liquidity for the hedge funds. A dollar rally is typical in a crisis, but an oil shock complicates it. If the dollar rallies too much, it tightens financial conditions even further. Do not be caught short the dollar against the yen or Swiss franc. If you own a car, you need gas. If you own a house, you need heating oil or natural gas. Don't try to trade your lifestyle. Hedge your portfolio, but don't disrupt your life. The goal is to be dangerous in the market, not reckless in your living room. Subscribe and hit the bell, because on March 31st, I'm dropping an emergency update the moment the decision is announced. Don't get caught asleep at the wheel. The countdown has begun.